Now we discuss relative strength index. As the majority oscillators are developed by Wallace Wider, relative strength index is the most valuable and most accepted oscillators to be used. RSI is also a very important part for identifying the exhaust and reversals. Relative strength index is a momentum oscillators that measures the speed and change of price movement. RSI oscillate between 0 to 100. According to Wilder, RSI is considered overbought when above 70 and oversold when below 30. Many of the traders also put this scale to 80 and 20 to identify the exact or at most confirmation of overbought and oversold. Signals can also be generated by looking divergences, failure swings and center line crossovers. RSI can also be used to identify the general trend. Let's understand the RSI calculation in simple form. RSI is basically a mathematical calculation that is simply identified as the picture show on your screen. That is, RSI is 100 minus 100 divided by 1 plus RS. Please mind that RS is not relative strength index. RS means a relative strength. Relative strength is calculated by an average gain over average loss. RSI has broken down into basic component RS, average gain, average loss. The RSI by default calculation based on 14 bars. As we know that ADX is also considered 14 and RSI is also considered the 14 candles. Losses are expressed as positive values, not the negative values. The first important calculation is done, the first average gain and the average loss. The sum of gain over the past 14 period is divided by 14. And the first average loss is the sum of loss over past 14 period divided by 14. By this we can get an average gain and the average loss. The second subsequent calculation is average gain equals to previous average gain into 13 plus the current gain divided by 14. Whereas to calculate the average loss, we have to use previous average loss into 13 plus current loss divided by 14. By the help of this formula, we can use the average gain and average loss. We have to understand the RSI parameters in detail. The look back period for the RSI is 14, but this can be lowered to increase the sensitivity or raise to decrease the sensitivity. It means 14 is not fixed for every kind of trader. If you want or get more signals, you have to decrease the time frame and increase the sensitivity so that you can get the more signals. If you have the time horizon of greater or a positional trading, you can increase the time frame and decrease the sensitivity. That means the trading signals now generated is less. 10 days RSI is more likely to reach overbought or oversold zone than the 20 days RSI. The look back parameter also depend upon the securities volatility. If the security volatility is already high, there is no need to decrease the look back period. RSI is considered overbought when it is above 70 and oversold when below 30. Raising overbought to 80 or lowering oversold to 20 will reduce the number of overbought and oversold signals. Short-term traders sometimes use 2 days RSI to look for overbought reading above 80 and oversold reading below 20. To get more and more trading signals, to get to a conclusion. Now we see a table that show on your screen which easily identify the overbought and the oversold zone. We also classified the overbought and oversold zone in a various parameters. The RSI level, if it considered to be 50, that means the expectation is no trend. If the RSI is moving between 50 to 70, we consider to be a positive trend. If RSI is between 70 to 85, it is a start of exhaust and we look for a divergences. If RSI is above 85, you must consider for immediate reversal. That means the exhaust is there. For the lower side RSI, we have to consider another table. The RSI 50 is no trend. RSI is between 30 to 50, it is a negative trend. If RSI is between 30 to 15, is exhaust or start of exhaust, and we look for a divergences. And if RSI is below 15, it is an immediate reversal. That means the exhaust will be at their at most. I hope by the help of these both tables, you can easily understand and get in detail of overbought and oversold conditions. Don't only look for 70 or 30. 70 and 30 is only a symbolic representation. For getting an absolute exhaust, you must follow these both tables. Now we consider if the RSI range is between 70 to 85 or 30 to 15, that means it is a case of a divergence. And we categorize this divergence into two parts. First is bullish divergence and the another part is negative divergence. Now we discuss the bullish divergence in detail. As we see the sample chart on your screen, at the last phase of the price will create a lower lows, but the relative strength index create a higher bottoms, and it clearly signifies that price will move in a downward direction and the rate of change will move in a upward direction. That is a case of a bullish divergence. A bullish divergence occurs when underlying security makes a lower low and RSI makes a higher low. RSI does not confirm the lower lows, and this shows a strengthening of positive movement or change of trend. Whereas in the next chart show on your screen is an example of bearish divergence. We easily see that the price will create a new highs and the rate of change is constantly fallen and create a lower tops. This example is best suited for bearish divergence. A bearish divergence forms when the security records a higher highs and the RSI form a lower highs. RSI does not confirm the new high and this shows a weakening of a momentum. The divergence not always show a reversal. Sometimes it is also shows a temporary consolidation or a small profit booking. So please use bullish divergence and bearish divergence with a greater cautiousness. Don't use the divergence only for the reversals. It can also be used for a upward trending or a downward trending. As a sample chart show on your screen, there is a swing rejections. As we discussed in the just prior, that don't use the divergence for only for the reversals. We can also use the divergence for a consolidation phase, and this consolidation phase again become a or resume in a prior trend. RSI behavior, when it is re-emerging from overbought and oversold territory, this signal is called as bullish or as swing reversal rejections and has four parts. The RSI falls into oversold territory, the RSI cross back above 30, That means he is not get into a lower point. RSI form another dip without crossing back into the oversold territory. Then RSI break its most recent high. That means this RSI down is an opportunity for a buyers, and it shows through a consolidation. There is also a bearish swing rejections, and that is also a 4 parts that show on your screen. The RSI rise into an overbought territory, RSI cross back below 70, RSI form another high without crossing back into overbought territory. This means that RSI breaks its most recent lows. The following charts illustrate the bearish swing rejection signals. I hope by the help of these charts and the formulas that we are creating exclusively for you, you can easily use RSI for any kind of situation.